Right, well, g'day there, everybody. Thanks a lot for joining me as at this Thursday afternoon market recap. This is a chart, the daily chart of the S&P 500 on my screen. I just wanted to point out a couple of, advancements that we have seen Monday through Thursday. Of course, the first three sessions of this week, we did see the markets pull on back. However, the question becomes, where did we see the reaction in the markets since, of course, this retracement, this very little retracement that we have been in Monday, really through to the open during today's session? And I'm going to count this down. Obviously, I cannot hear you, but 3, 2, 1. The answer to that is somewhere, at least in locational terms, somewhere between the 10 exponential moving average and the 20 exponential moving average. Let me make the point of distinction that these exponential moving averages are most certainly rising. And we have seen price most recently bring out or sort of break out above these all-time high resistance levels. Now, again, we spoke about this in the week just gone in that Pivot Point Pro analysis class. We really were talking about the art versus the science of technical trading, whereby we would assume if the markets were to pull back, right, that we would see it generally occur somewhere between the 10 and the 20 exponential moving average in this particular occasion. It's quite interesting because the candlestick today is a two-day reversal signal, and it is what we call that of a bullish piercing pattern. Okay, I was going to give you a little bit of a break just so you could sort of think through it yourself and come up with the terminology, or at least the candlestick recognition. But again, just to repeat myself, this is what we call, right, a bullish piercing candlestick, whereby we see the original gap down, where it looks as though we are continuing in the bearish direction that we have printed Monday through Wednesday. However, we see a reaction, or at least a change in direction, and we close and we push at least halfway into the previous dark days candlestick. Again, the candlestick itself, it derives its meaning at the right location. And in essence, right now, the right location, or at least this location, is completely correct, whereby we are seeing price action pull on back down into the rising exponential moving averages. And this is the very first sort of reversal signal that we have that potentially we might be setting up that of a bull flag continuation. Again, what we spoke about over the weekend, just to share this with you, was that when you think about market discounts, whereby the market itself is offering you, right, an opportunity to get into the market if you haven't already done so, or at least to add to existing positions, right, at one of the best prices possible. Obviously, you're not going to get the best possible price in the market, but at a discounted price, i.e., what we saw during the reversal candle today, that is exactly, right, what has transpired. And there's a very good chance that we're not actually going to linger back down here at 2,968. This was the area whereby the 20 exponential moving average essentially came on up and acted as that support area for the S&P 500. Now, I just wanted to rejig your memory also. So again, what we're seeing here is potentially that of the continuation through candlestick analysis off of the rising 20, or at least a blended formation of the 10 and the 20 exponential moving average mixed with that of a bull flag continuation. All right, so that's the bullish case at this particular juncture. Alternatively, as I've floated in the past, we still have a series of open windows that not necessarily need to be closed. I've spoken about this type of gap, and whereby you see a market or an actual individual stock gap above its all-time high. Generally, it is taken into consideration of being that of a continuation gap, or what we call the measuring gap, all right, whereby you see the market just simply continue in the bullish direction. So we don't necessarily, okay, pardon me, I'm still a little bit fluey. You can still obviously tell in my voice that I'm a little bit sort of congested in the sinuses. But anyway, we've closed this gap over here. We still have this lower gap over here that doesn't necessarily need to fill. And if I had to assume, or at least guess what I believe is going to happen, I think the markets are going to be strong enough, and there are going to be enough traders who are willing to jump on in at current market levels, okay, to propel price higher once we break out of this, right, bull flag, okay? If that doesn't happen and we see the market pulling back down to 29.50, so be it. It is the final opportunity to position yourself into this market prior to the successful retest, all right, and the continuation to higher prices. This is not only pertinent, to that of the S&P 500, it's also pertinent, of course, to the Dow Jones Industrial Average. It is taking a sort of similar type of formation, a little bit of a bull flag, not as nice, or at least not as developed or as clear, as precise as what you're seeing on the S&P 500, but certainly it is there. What we have today is a little bit of a spinning top on the Dow Jones. We closed up 3 points, which was interesting. Again, on the S&P, we closed up 10 points, even though, again, we opened net negative to begin this session. But the same is true. We're looking to see the exponential moving averages hold price somewhere between the 10 to 20. Look, it may even happen between the 20 and the 50. What we want to see, of course, is a reaction off from these rising EMAs and to see price action take out these swing highs over here. And that's exactly what I believe we're starting to see as at the candlestick construction, or at least the sort of the end of day print, as at Thursday. Now, there's a couple of stocks that I very quickly wanted to speak about. One in particular was IBM. IBM had its earnings. Look at this, a big, long day, white Morobozu candlestick. This is broken above the radioactive area. This is something whereby at this particular time, if I can zoom out and show you this on the weekly chart, we need to leave it. The reason for that is because we are back up into this resistance area. And generally what you see, okay, just to let you in with not going into like all that much detail as to what I'm going to do tomorrow, is generally after you see a long day Morobozu candlestick after breaking above this sort of declining resistance area up into another resistance, is generally you get a slowdown for a number of days whereby it will set up that that sort of stair-step continuation pattern whereby you break above the high of the candle, or at least wherever the perimeter is of that upper resistance after maybe 2, 3, 4 days of a sideways move, and then you can bracket trade the impending breakout or the continuation to the upside. So the good news for IBM right now is that we've broken above, all right, the radioactive, the resistance area whereby we liquidated a lot of our long positions, the long positions that we were beginning to jump in at 132, 135, 136. We closed them out at 142, but now IBM is trading up. At least intra-session, it got up higher than $150 a share, which is a very powerful move. Now, again, the bifurcation in this market, or at least between these two stocks, is rather quite apparent when we look at that of Netflix. Have a look at this. We closed down or gap down quite a distance. We closed down $37 on the daily time frame. The bad news for Netflix, so one, this is a really good learning opportunity, by the way. You hear me say all of the time, all right, close out positions prior to earnings. And this is the exact reason why. Obviously, we do not understand, or at least we can speculate what we believe is going to happen once earnings is reported. But it's never a good idea to actually have that as your trading strategy. All right, it's very foolish, and I would encourage you to stop or at least cease trading immediately, effective immediately, if you are holding positions over earnings. Netflix is a great example. Even, of course, IBM trades to the upside, Netflix gaps down, and it doesn't look back. So again, I've got a lot of emails this week from people saying, hey, thank you for telling me to close out of this position prior to earnings. Otherwise, I would have sort of, lost my shirt on the trade. And again, it's a really good sort of reason as to why we close these trades out and we don't speculate over earnings, especially holding options contracts. Now, again, Netflix is triggered, or it hasn't triggered. Let me rephrase that. This is gone. Okay, this was a bidirectional bracket trade after earnings. Now, earnings came out today. What is most important, if there's something that you can visualize on, is this support area just here. This is coming in at 330. There is actually, if I want to be very sort of microscopic about this, again, I generally just like doing the ranges when we actually understand that we are in a range-bound market, right? I don't like to have too many lines on through here. But what is going on with Netflix, I assume at this particular point, is that we've made a turn. I was actually becoming very bullish on Netflix during this accumulation, and I hope I'm wrong on this, but it wouldn't surprise me to see Netflix actually rally on back on up and actually hit 345, or to come on up to say 360, close this window, and then essentially roll, because this type of accumulation, all right, is very powerful as long as you hold above the support area. When the dynamic breaks, and I've used the word, or at least the term dynamic recently when it comes to the market activity, and it's somewhat interesting because the dynamic of the market would be, if we wanted to use the Netflix sort of case scenario right now, would be prices getting above resistance, and that dynamic has shifted into a bullish sort of favorability. But according to Netflix right now, it has shifted, but it's shifted in the bearish direction quite strongly. So again, the easy thing to do is to push a little bit of a bearish trigger below the low of Thursday's candlestick. I'm going to leave it for a session. I think there's a good chance we're going to get an inside day candlestick on Friday. And then what we'll most likely do is set up a bidirectional trade whereby we'll close the gap up to 360, or it's going to be a gap and go trigger back down to 280 at an absolute minimum. I'm not going to do it as at the close on Thursday. This is going to be something we speak about in more detail once we have another day's worth of session. That being, of course, Friday's trading candle. Now, again, a lot of individual stocks, all right, are still moving into earnings. We've got Amazon, which is closely moving towards its earnings state. Boeing Airlines is very close. Baidu, it's getting there. It's still technically in the month of July. Caterpillar is certainly just around the corner. ConocoPhillips is towards at least the back end of July as well. The majority of these stocks are reporting, obviously. We are very firmly in earnings season. So again, if you find yourself light on trading activity at the moment, don't be upset about it. Just understand that it's the best thing to do at this particular juncture, if, of course, you are not willing to jump into market positions at a discount, whether it's on the diamonds, the SPYs, or the Qs. where you should be focusing right now, okay, if I may say so, in my humble opinion, outside of individual trade analysis, knowing that we are in earnings, is certainly looking for, right, good prices to enter into longer term options contracts for the bullish direction once the successful retest of either this resistance turn support is done or, right, a very quick retest of these rising exponential moving averages. It's speculation as to which of the two it's going to be, but what you should be thinking about is that the market, especially the S&P 500, is offering you a little bit of a discount. It's offering, or it was at least as at the close on Wednesday, offering you prices back to the very early period of July. Okay, and as such, this is where my focus is until, of course, we move through earnings season. All right, it's just very, very risky to be forcing trades in earnings when you need to liquidate the position within a week, or say generally under 2 weeks. Generally, you sit on the sidelines and say, well, I'll just wait until that earnings gap is done, and then I'll look for the continuation type of trade or the fade the gap trade, depending on, obviously, the circumstances, the macro sort of snapshot of the stock itself, and a few other factors as well, especially that of the market indices too. All right, so that's going to do us as at Thursday. Encourage you to jump into that pro analysis class for Saturday. Otherwise, everybody, enjoy your Thursday evening, and I will see you in due course. All the best. Farewell.